All right, good morning to everybody. We'll go ahead and get started. And today is Wednesday, and so we're in week one of the course still, obviously. And I just wanted to sort of refresh a little bit as to where we are, where we've been, and whatnot. So I wanted to bring back the syllabus here, just to be sure that everyone is. There we go. And I've kind of darkened it as much as I can. Hopefully everyone watching on video on live Zoom can see that. If not, I hope you'll let me know. I have not, as I mentioned on Monday, I've not taught in this room before, so I'm not familiar with the lighting as much as I am. I've always done it at main campus in Max Salazar. But so if you have trouble seeing, let me know. If you have trouble hearing or whatever, if there's any kind of technical issue that I'm unaware of just because I'm here and you're there, let me know. We'll fix that. Okay. So for this week, as I mentioned Monday, it's a pretty light workload, and really you should be able to knock this out quickly if you haven't already done so. If you haven't done this, I would do this. I would do it today. I would do it before, just to finish it. Because all you have to do is there's a syllabus quiz that just basically asks some questions about the overall structure of the course. This is built into the course by the course designers, just so that everyone has an idea of where the course is going, what we're doing, when things are due, and whatnot. Now, I know that somebody from your section had pointed out that there's a question on there. I didn't write the quiz, so I was not familiar with the question, but there was a question that said, they asked when the final exam was due, and the correct answer for the quiz purpose is Wednesday, I guess the 4th, but I had moved that due date back to December 6th, which is a Friday, because to me it didn't make much sense to have a due date on Wednesday when we still have class on Wednesday. So what's the point of having class if the final exam is due that day? So I pushed that exam back. Doesn't matter what you answer on that. I'm going to go in probably on Monday or Tuesday, I guess. We are going to lose a day on Monday for Labor Day, obviously, but I'll probably go in on Tuesday and adjust everyone's answer to give you credit for that, regardless of what you answered. These are pretty low stakes activities anyway. Syllabus quiz, there's an introduction discussion, and then there's an academic integrity question. Just to kind of show you how to get there, particularly if you're less familiar with Brightspace than some others might be. If you go into hopefully everyone can see this is the main landing page here. If you go to coursework content, that's probably going to be your go-to place pretty much on every access. There's an orientation link which relates to first week's activities, and it's all here. Class introductions, which is a discussion activity, and the requirements are self-explanatory. There's no research to be done. It's just just to get to know. It's an icebreaker activity, and it's just a way for you to register attendance and whatever. I mean, it's just a way to get involved in the course. The quiz is here, and then the academic integrity questions here. And notice with every module, and I mentioned on Monday, that the course is not designed, these modules along the left are not designed by week, but by module. Module being usually referring to the chapter in the text that we're covering. But this week is a little bit different because it's orientation week, so it's all there. But if you click on the checklist, it's a nice little checklist that will show you, what all needs to be done. And I think they're pretty thorough. I think I did some updating on some of these checklists before the semester began. By the way, before every class Zoom session, I'll post a link to this particular session so you can click into it live if you want. That would be the link. There is no password ever, so you shouldn't have to worry about that. And it's in Zoom, which means you can watch it on your phone live or wherever you're at work, whatever the case might be. It's up to you. Or I will post the link afterwards, and you can look at that later. Now, by the way, I did this on Monday. It was later in the day because I had to. The system has to kind of process it. It converts it to an MP4 and whatnot. So, and I sent everybody an email, and I also posted an announcement. But if you go to chapter 10, which is really where we are. I mean, we already started to get into some of the content for chapter 10. If you go to the chapter 10 module, and by the way, my view is a little bit different than yours. Let me go to your view here, just so it's a little bit more realistic. So if you go to coursework content, week 10, chapter 10, financial analysis, you go all the way down, and there's the link right there. And you can't, this is not clickable. I don't think you can click and go straight there. You might be able to, I don't know. I tried to do that though, and I didn't get anywhere. But if you just copy it into a browser, it's a YouTube video. I uploaded it to YouTube. I've got a YouTube channel. It's got a bunch of videos, and I'm sure I've got like 40 or 50 videos. I don't think you want to look at them all. A lot of them for old sections, and there's no password protection on those either. So that's where you'll find every class session's recording, because I do record every class session so that everyone can watch at some point at your leisure. And so again, as I mentioned on Monday, personally, I think this is the most ideal way to take a class. Really, I believe that, and for your benefit, probably more than anyone else, just because of the fact that it gives you so many different options as to how you want to attend. And I suspect a lot of people are going to want to watch the video sometime in their leisure. And by the way, you can come to class or watch the live Zoom and then go, I'd also watch the video. You're free to do it. You can stop, back up, fast forward, blow up the picture, raise the volume, all those kind of great things you can't do sitting in a face-to-face classroom necessarily. So that's good. Okay. All right. Anyone have any questions either on the Zoom call or here in the classroom before we get rolling today? Okay, I just want to circle back one more time to the syllabus, then we'll move on back into chapter 10. So for this, oops, sorry about that. I'm one of the big offenders when it comes to cell phones. This is why I'm not as big a Nazi on cell phones as some instructors are. Some instructors just get real hardcore. I do not, because usually I'm one of the people whose phones are going off. But I'm going to go ahead and jump into chapter 10, even though it's not technically assigned until next week, and we've got plenty of time to get to it. Keep in mind, our first exam is not until week 6, and that's good. That's really their main activity. And it's going to cover the first 3 chapters, chapter 10, chapter 11, chapter 12. Okay, but we have work to be doing in the meantime. So next week, when it says E and P, those are exercise and problems, those relate to homework or assignments, whatever you want to call it. Then the quiz, and then there's a bonus activity. And this is the typical sequence of activities per module: homework, quiz, bonus, homework, quiz, bonus. In some weeks, and beginning week 4, we'll have a discussion activity as well. And as we get closer to that, I'll talk more about what the discussion requirements and expectations are there. There is a tendency at times, I think, to get a little bit overly informal and not really get to the point. And that's an area I want to try to help you avoid. So we're going to get into chapter 10 today. By the way, we're going to miss a day, Monday, for Labor Day, so we'll have one day next week. So we're not really pressed at all for time, I don't believe. So we should be in pretty good shape as we go forward here. Okay, so all right, let's do this. Let's get that. Oh, by the way, if anybody on the Zoom call has any questions or wants to jump in, just go ahead and shout out. It's not, you don't have to worry about, we're not big on formality or protocol, and that's the only way I know that you're there. I mean, I do try to check the chat box, and I'll check it now just before we get going. And so if you have a question, no, looks like we do have a message. I don't know what that means. Anton, you wrote something in the chat box. I don't understand what that means. So anyway, if you want to elaborate, you can do that. So, but if you do, you can say it live. I do appreciate the people who are live on Zoom muting their microphones. I know before COVID, we were all kind of new to this, and we have dogs and kids and you name it going on in the background. So I appreciate that sort of thing. Okay. All right. Questions before we get started, and we'll jump. Okay. All right. Good enough. Thank you, Anton. Appreciate that. Okay. I just want to make sure I addressed your question. I didn't want to skip over it. Okay. So we're talking about chapter 10. Now, let me just rephrase or restate what we talked about on Monday about chapter 10. So, and to do that, I'll go back, and I'm repeating myself a little bit, but I think it sometimes bears a little bit of repeating as to what 2120 this course is about. It's really the second half. It's the back half. It's the complement course to Accounting 2110. 2110 deals with financial accounting, which is basically reporting in a standardized format to external users primarily: investors, lenders, regulators, insurers, anybody who's interested, pension funds, insurance companies, you name it. Anybody outside the organization that follows certain rules. in 2120, it focuses on what's called managerial accounting, which is the other branch. Financial accounting is sort of one branch of accounting. Managerial is the other. And it's internal accounting for managers only. However, chapter 10 that we're going to be talking about this week and next is the last bit of financial accounting. But when the course designers put this together, they didn't, because there are more chapters in this same text. It's the same text, very same text we used for 2110. There are more chapters dealing with financial accounting and managerial. So we decided to balance it and so to roll this into this particular course. So this is really a financial accounting piece, but it's important too. And I think that some of this information, by the way, for those of you who are interested in investing and watching your own investments, making your own investment decisions, some of this stuff is really pretty useful because a lot of people do that. A lot of people are sort of taking advantage of what they learn in courses like this in order to help manage their money and to make their own choices. And so some of this should be helpful. So in this chapter, we're skipping over the first learning objective. It's the only time we're skipping really any of the learning objectives in any of the chapters. We're going straight into the second objective, which is horizontal and vertical analysis. And so I think we ended up on Monday, sorry, I'll get the day right, talking a little bit about what horizontal and vertical analysis is. When we talk about horizontal and vertical analysis, what we're literally talking about is horizontal, meaning across, and this is I pulled up the a website out of Yahoo Finance for General Mills. I think I had Kellogg on Monday, which is now called Kellanova, and I didn't pick these two companies, General Mills and Kellogg, randomly. There's a running example in the text about two hypothetical cereal companies, but I thought, well, rather than getting the hypotheticals, why not just bring in real cereal companies? And notice a horizontal analysis would be, okay, I know this is really small. I get that I can try to blow it up a little bit, but I don't want to forget to unblow it up. But and if you want the link, it's very easy to get to. If anybody wants to know how to get to any of this I can show you. And I'm losing some of the screen. But if you go across time, it looks like their fiscal year end is May 31st, $18.9 billion in sales. That went up to 20 billion. That dropped a bit in the last year for reasons that I think, as a financial analyst, a former analyst, I want to know why. What's going on, right? And this would be so horizontal analysis is a time series sort of analysis. Vertical analysis, on the other hand, would be taking the same information, and let's just take the same income statement here and say, okay, what is gross profit in relation to total revenue? What is gross profit in relation to total revenue in the prior year? Or any of these analyses within the same time period are relevant to what's going on in vertical analysis. So real briefly, I know I covered just a little bit of this on Monday, but we talked about what are investors interested in. Remember, this is the last bit of chapter of really what have gone into 2110. They're interested in sustainable earnings, that is, not including extraordinary items or discontinued operations. And then we talk about these ratios. We're talking about intra-company, that is within the same company, or inter-company within the same industry. And so it's important to realize that, okay, so we were looking a second ago at General Mills. What about, if we're looking at the same industry, what about if we took a look at, let me see here, Kellanova, which is the name for the Kellogg company. Well, you've got two different kind of companies, and let me put it on the income statement here. So, and you've got really two different sorts of sales analyses. So look at it this way. So General Mills, as of the end of this most recent fiscal year, remember, fiscal year is simply their business year. It ended May 31st of this year, $19.8 billion in sales. By the way, I wanted to mention that one thing that's important, and it's something that people sometimes miss, is we're talking about really big numbers. I mean, you could add 3 more zeros to this to make it 19 billion, but instead, and a lot of times, since now we're talking about big companies doing business in the billions, literally, almost all the big companies do at least $1 billion in sales. I mean, that's 9 figures beyond the first comma. So a lot of times they'll just abbreviate. They'll say in thousands, meaning you would add 3 zeros to them. If it was in millions, you would chop off this part here, and we see that commonly as well. So make sure when you're looking at these numbers to be aware of what's being cut off. It's being truncated, in other words, in order to do that. All right, so what was I saying about Kellogg? So they did about, I'm sorry, General Mills did about $19.8 billion in sales. So General Mills as of the most recent fiscal year. Okay, if you compare that back to Kellogg did about 13 billion in sales. So they're different companies. One is about half again as big. That is, General Mills is about half again as big as Kellogg. So you might think, well, how do you compare these? Isn't this an apples and oranges comparison? Not really, because you can use certain analyses and certain tools that we're going to talk about to get an assessment of how each company is performing relative to each other, relative to the industry, and for internal purposes, which is going to bring it back to what we're doing in this course, is how does the financial performance align with internal benchmarks? That's going to be an important aspect of where we're going in this course is how do things line up with what we have set? We manage, I'm saying we, as if we were a manager, setting what is our benchmark? What do we expect to do, right? We want to set the bar high, but we also want to set it attainably. And I mean, we don't want to, say that, I mean, if we're Kellogg and we did 13 billion in sales last year, we're not going to say we're going to do 18 billion this next year. Where's that going to come from? We're going to get 5 billion in sales. Maybe in 10 years or 5 years or whatever, maybe you can get to that point. But I mean, you've got to be realistic with those goals. And I will probably talk a lot about this as we get going in the course, where there are managers out there in the world, frankly, who, particularly people who are newer to their positions in management, who have all this ambition, who want to push the ball forward and say, we're going to do all these great things. It's too overly optimistic, and they ended up kind of falling on their face, mostly because they're overly ambitious and they think they can sort of force the issue and raise sales. Maybe you can get to 18 billion if you cut prices dramatically, but then you hurt profitability. So these are all issues that we want to talk about. So anyway, let's go back to, so when we talk about horizontal vertical analysis, and again, horizontal and vertical are what they are, literally made out to be, either within the same company, to be useful, or intercompany, or based on industry averages, okay? And then the three tools are horizontal, vertical, and ratio, okay? Now, ratio analysis we're going to talk about. I think we're going to probably get there today, I hope. If not, we'll certainly get there on Wednesday. But what we're doing here is we're comparing these either to benchmarks or to those of other companies. And we'll talk about certain ratios. A ratio is simply one variable in relation to another variable. That's all it really is. And there are a number of important ones that we will talk about, okay? All right, so this is, I think, where we left off last time. I know I backed up a little bit, but again, I mentioned on Monday that we do have people who are still enrolling in the course, and I think that'll probably continue through. I don't think you do it as of two. I know usually Monday is the cut. Monday after the first week is the cutoff for new registrations, but we're not here on Monday, so. But I would suspect this week we'll probably be done with new enrollees, but I didn't want to get too far ahead of them on Monday. All right, horizontal analysis. This is the last thing we talked about Monday, was also called trend analysis. That is, how is the company doing? And sometimes, I know when I was a young financial analyst, and I say young because it's my first job, we would get company financial statements, and we would just start looking at them, just start tearing into them, just eyeballing them and saying, okay, what's going on? What did revenue do this year versus last year? What's going on with cost of goods sold, which they're calling cost of revenue? Same thing. By the way, if you took 2110, you probably have already sort of gotten your arms around this, but we have different terms for the same thing in accounting. That's very maddening. The term revenue is also, this term sales also refers to revenue. Sometimes revenue will be broken up by merchandise revenue or manufacturing revenue or service revenue or whatever, or it will just be called sales. And it's the same term. It's the very same thing. Cost of revenue is the same as cost of goods sold. And particularly if there's a firm that deals with any kind of inventory, you'll have a cost of goods sold. This is a little bit unusual to have a company that deals with merchandise, which is a manufacturing company, calling it cost of revenue. We see that a lot in service organizations. And I bring up Yahoo Finance only because I think most people are probably familiar with Yahoo, but there are lots of different sources of information. And on publicly traded companies, which again, as I mentioned Monday, is the point of view that we're taking throughout this course of a corporate form, not partnerships or sole proprietorships, but corporations. And that we're dealing with fairly large corporations whose stock trades in the public markets, New York Stock Exchange, NASDAQ, whatever, okay? And so we're taking that particular point of view really throughout, even in the internal view that we're doing in managerial accounting. So we have different terms for the same thing as we, and it's worse in financial accounting than it is managerial, but it does exist. It's a thing, and it's just a thing to be looked at. So trend analysis basically says what's going on over time, and in order to determine whether it's an increase or decrease, and we can express it in either dollar terms or in percentage terms, or and the green ink on all these slides is my own offering, or both. And in fact, that's very often what we'll do. And we'll talk about what some of these analyses look like as they're prepared. Okay. So one important thing, and this is important, honestly, this is important everywhere in business, is this idea of the percentage change in something, whatever it is. This comes up all the time, and where somebody will know, what is the percentage change in sales for, region B or whatever, or what is the percentage change in payroll from last year to the next? And believe it or not, there are a lot of people in the business world who are not clear on what goes in the denominator here. So one rule of thumb here is that whenever you're doing the percentage change in something, it's always going to be the new value minus the old value over the old value. Do not put the new value down here because that's not the right answer. You're comparing it to the old situation. Now, in this case, they've phrased this as current year minus base year. A base year is simply any reference year, which we would call something old, obviously. And then the base year is the denominator here. So if we're saying, let's just, in very simple terms, if we've got sales have gone from 150 to 200, right? Okay, so 150 in last year was the old sales. This year it's 200 with the old sales. Then what do we have here? We have 50 divided by 150, which gives us 0.33 or 33% as an increase in sales from one year to the next. And by the way, and I will say this, hopefully everyone can see that. I know it's maybe a little bit difficult to see, and we've got some trade-offs we have to make. Maybe that's worse, I don't know. We have some trade-offs we have to make with having to have a screen up and a camera rolling. I just don't have much board space to work with. I'll try to do my best. I will be needing the board, particularly as we start talking about some of the problems and whatnot. But for right now, I want to focus more on material up here. But I'll say this enough, you'll get tired of hearing it, but I like to keep things in I would encourage everybody to view fractional items in terms of decimals. I think it better matches the input and output of calculators and computers. Percentages are fine. All you do is move the decimal 2 points to the right to convert it to a percentage, obviously. If you have a percentage, you want to move it back to a decimal, move it 2 points to the left. I mean, we should all know that. But just get familiar, when you see 0.33, actually it's 0.33333. It's 1/3, or it's 33%. So just kind of be familiar with that. We will do a number of computations in this course. However, this is not a pure math course. I know my former colleague Marty Epstein would always try to emphasize to students who said, I'm not good at math, I'm not good at math. And it's like, well, the math is a part of it, but this is not a math course, and accounting is not considered math. It really is not. The majority of what we do in accounting is not really that much in terms of calculations. And it's not, a not so dirty secret is the fact that a lot of what we do is entered in computers, and the computers do all the hardcore number crunching. We'll do some of it here just to introduce you to how it's done in the first place. Okay. So percentage change is an important metric. So if we're taking 2024 to 2023, and by the way, if you took the course recently with this Wiley version, for whatever reason, they got the years 2027, 20. I don't know why they've gone out in the future, but they have. It doesn't really matter. But if you're taking 2023 to 2024, you would take 9614 minus 8812 over 8812. New minus old over old. New minus old over old. That is something to remember. And I can't tell you how often this comes up as an issue in the business world. And for those of you who will, at some point, maybe you are already, but if you're working with spreadsheets, entering this formula, just simply into an Excel formula, in your box, on your line item, equal sign, whatever value minus whatever value, quantity divided by the old value. That is all the time. And there's cells, obviously. Those are entered all the time and are used frequently. And even for things like scenario analysis, and we're going to talk about budgeting as we get going in this class and how budgets are forecasts. And there are a lot of what ifs that are being done in the real world I say real world, I'm talking about in the actual business world, as we enter data that we think are going to be possible and what's it going to look like. And sometimes this is the beauty of spreadsheets. And I know I'm probably the oldest person involved in this class. And I go back to days when we didn't really have spreadsheets, were just in their infancy. We were doing actually by hand, if you can believe it. I know I sound like I'm from the Middle Ages, but this is a lot of good things can come about through the electronic spreadsheets like Excel. Okay, so this is an example of how horizontal analysis will be used, where we're trying to find out what is the percentage change. Now, by the way, so between 2023, maybe the growth in, I don't know, say 12% between one year and the next. And the next year it goes up, it maybe falls to 9%, then it falls to 8%. That would be a trend that I think would be maybe a little bit alarming to management, unless that was something that was desired. Sometimes it is desired to slow sales down. Mostly so that the company doesn't burn through too much cash because a lot of their receivables are out there and they're, so sometimes companies want to hit the brakes a little bit. But in general, when we talk about sales, most companies by far would say as a default position, you want to increase sales over time. A lot of good things happen through increasing sales. And if you compare that to the opposite condition, decreasing sales, that's probably worse than excessively increasing. And by the way, in today's world, there's so much financial capital sloshing around that if you're growing rapidly, you can pretty much always find somebody to inject money into your business. There's a ton of money I say sloshing around because it really is looking for a home. So if you're growing rapidly, you can find a place for it. So this is an example. And by the way, you can refer to chapter 10 in your text. Chicago Cereal is one of the hypothetical examples. Now, I say hypothetical. I don't think there is a company called Chicago Cereal. But in this case, we go back to the prior slide here, and the 2 years in question were 2023 to 2024. So we take new minus old. 2024 is new. 2023 is old. 9614 minus 8812. That's this, divided by the old value of 8812, gives us a percentage increase of 9.1. I said 12%, I was just guessing. 9.1% increase in sales from one year to the next. That's a perfect example of horizontal analysis. What are we doing now? This is what we did then, okay? That sort of thing. And so and by the way, I know this is I don't know why the authors went out in the future, because one of the things about financial analysis is practically all the information we're looking at is historical. Yes, we do forecasts, but I mean, so I don't know, but they're pretending that 2027 has already happened because it's in the books. I don't know, but we'll just deal with it. It is what it is. So, all right, if we take between 2027 and 2023, what happened to net sales? Okay, so sales went from 8812 to 11776. Again, when we're chopping out some zeros there, probably. And so we end up with an increase of 33% over that period of time. Notice that would imply some sort of slowdown because this is a 4-year stretch versus a 1-year stretch. And if we were on the same track, we would be somewhere theoretically around 36. So maybe sales have slowed down. And is that a good thing? Is that a bad thing? I think that's the question. These numbers in and of themselves don't mean anything. They have to be taken in context. And this is one thing that I think is very important for us to understand about financial analysis in general. The numbers don't mean anything unless you put them in context and know what is really going on. You can have a company like Apple doing several hundred billion in sales per year, but maybe that might sound great. Maybe the sales are down as a percentage increase. Well, maybe that's not a good thing when they want to increase sales. One final thing, and I'll come back to this as we get into the ratio analysis bit, in particular the vertical analysis. Right now we're focusing mostly on horizontal, but when we come back to vertical, this will become a little clearer. Remember what net sales is. Net sales is gross sales minus discounts, if there are any, and returns and allowances, if there are any. It's just a way that in the financial accounting world, managers and investors want to see what net sales are, because it accounts for any discounts that are offered to buyers, as well as probably the most important thing, and those are contra revenue accounts. Those are, remember, any kind of a contra account is a deduction from the account to which it refers, and on a financial statement, it's the account usually right above it on the line item. And returns are an important one. So net sales would include having taken out any kind of returns. That is merchandise that's been sent back. It's damaged. It's wrong. It's not the right order. It's expired. It's whatever. It's defective. It's been recalled by the government. Whatever the case may be. So net sales are what we key off of. That's an important metric. And as we get into vertical analysis, it will become a little clearer. Okay. And then, so when we talk about this, we talk about some sort of relationship between current and base year. Whenever we use a base year, we're simply referring to some year that is going to be a good reference point going forward. And what's really interesting, and I don't know if I really got into this that much on Monday, but we're coming out of a period in which some of the base year identification is really going to change, because when we went through COVID, a lot of things, COVID was just a strange time for everyone, including businesses. Some businesses saw sales soar through the roof. I mean, you know, companies like Netflix did extremely well because everyone was sort of cooped up at home, and Peloton and the cable companies and all that. But some companies didn't do very well, like hotel chains and airlines, and people just weren't traveling, weren't getting out. Restaurant chains. Well, now that we're out of COVID, knock on the wood, hopefully we're not going to. I know COVID is coming back in some cases, but in some places, but now that we're past COVID, we need to pick a base year that does not include those COVID years, because those are not really good benchmarks for a reference. I mean, because it was just a strange, very strange period of time. So if we're trying to find a benchmark year, now we're probably going to have to look at some year past COVID, and in order to go forward from there. So that's, I think, what is really interesting about horizontal analysis is you've got none of this information makes any kind of sense except in relation to other information. And by the way, all these PowerPoint slides are in the text itself, or I'm sorry, in Brightspace, in the module itself. And I cut some of them out because some of them are better than others. So I can't say this is on slide 14 or whatever necessarily, because sometimes I might change it. But I do want to add my own bit to it in order to give a little bit more context. And I do bring in other outside resources at times as well. Okay. All right. So horizontal analysis, just to sort of summarize here, net sales is really the key issue here. And so what are you trying to do here? You're trying to track the change over time. And so if you're picking a base year 2023, right? 8.8, say billion. What is 8.8 million? It's in thousands. So you had 3 zeros, 8.8 million in sales. 100% of that, it's the base year. So everything is in relation to that year. So 2024 sales grew 9.1%, or 109.1% of that original sales, original being base year. And if sales are growing, so will the percentage. So this is where we get the 33.6, or 133% of that previous year, of that base year, if that makes sense. And this is how trend analysis can be used. Now, one thing, a bit of caution here is that as we get way further out in time, and we're still applying percentages, it becomes very misleading. We were talking about Yahoo Finance. If you pull up a stock in Yahoo Finance, just any company like Microsoft or whatever, a company that's had just dramatic, huge sales, and there's a chart in there, and you want to expand the percentage growth in the stock price, which is not really a focus of this course. You'll see the percentages are in thousands of percent, right? Which is almost a little bit difficult to sort of parse through. Percentages become a little bit less meaningful when you get over very large timeframes, but in shorter timeframes, in 5 years certainly would be a shorter timeframe that does make sense. Okay. Any questions so far before we get out of horizontal analysis? Okay. Okay, and the large increase in net sales would raise questions regarding reasons for change. And then one thing I'll talk about here, and if you took 2110, I know, and I can't speak for all faculty members, but I do try to get into public company, examples of public company reporting. The reason we call companies like General Mills and Kellogg and Boeing and Apple and you name it, it's thousands of companies. Why we call them public is because their information is public. They also sell their shares to the public. Those are ownership bits, little fractional ownership pieces of paper that are bought and sold, but they have to also report their information publicly. And very often what analysts will look at is this area of the notes to financial statements, which go on page after page after page. And I didn't pull one up for this example, but I made for Wednesday, just to kind of give you a bit of an idea of what that is. And if we talk about external users, again, we're still on sort of the financial accounting bit of this. Who are the external users? It's a lot of investment firms, mutual funds, companies like that, where financial and bankers, where they tear into these financial statements and they really focus a lot on the notes. Because the numbers themselves tell a story, but maybe not the whole story as to why something is going on. I'll just give you one example from my days in graduate school when we had a long case study of a company that was a grocery store chain, Kroger. It's a nationwide company. It's a company that owns Smith's, and in Colorado they own King Soopers and whatnot. And they use a LIFO inventory method from the last in, first out. And it's a grocery store chain, and that doesn't make sense, does it? That the oldest milk is the stuff you're not selling, and the newest milk is the stuff you're selling, and some of the inventory on your books, eggs and milk and green beans, has been sitting around for 10 years, 20 years. So they have to make an adjustment, and that's what an analyst would look at. What would be the accounting if they use FIFO? Remember, FIFO, when prices are rising, is going to give you a higher net income. LIFO is going to bring down your net income when prices are rising. But the reason companies use it is because it lowers their tax obligation. It lowers their net income and lowers their tax obligation. Well, that's something that the analysts would want to figure out, because we all know there is absolutely no way that any kind of company that has perishable, expiring goods is going to be selling all their newest stuff sooner, and then the stuff they didn't sell is the stuff they bought 15 years ago. That's completely mythological. It doesn't exist, but it is allowed and allowable under GAAP standards. That'll be all disclosed in the notes. And so the notes are important that allow us to understand what's really going on behind the numbers. By the way, I'll say this about, and this sounds a little bit cynical, but I had a long career in finance and then in accounting. A lot of companies will put the nicest shine on the picture that they can. And sometimes they maybe they just had a dreadful year or not so good year, and they'll talk about why that was the case and why things are going to be better and things that were outside of their control and all these kind of things. And the notes will sort of allow you to get a bit of a glimpse into management's thinking on this. It is appreciated when management is very forthright and says, look, we had trouble last year. There was a company, Rubbermaid, company that made a lot of kitchen products, had some couple of dreadful years. They said, look, we cannot control the price of rubber and plastic, which is most of what their products are made of. We are just having trouble controlling it, so our costs are rising, and we're doing our best, but whatever. That will be disclosed in the notes. And so those are explanations behind the numbers, okay? Now, and to this case, the question was, okay, why did sales go up? Well, it could be because there was a major acquisition of a competitor, potentially. That would boost sales right away. You're absorbing some other company's business. And by the way, this has been going on really since the beginning of capitalism in this country. Literally, I'm not exaggerating. Companies have been buying other companies. I know that we sometimes hear the news and think it's some new thing, companies buying other companies. So this has been going on from day one, and there's a reason for it, and that's the idea that you take a competitor off the shelf. Now they're on your team. That's kind of nice, right? And you double, triple your sales, whatever the number is, and that's a good thing usually. And you can eliminate redundant operations. You only need one accounting department, one IT department, one HR department, you name it, right? Okay, so real quickly before we get into vertical analysis, this is an example. I don't know if you can see this on the watching live in the Zoom, but this is the Chicago Serial Company. It's a condensed balance sheet, and it doesn't have a year. Well, I guess it does have a year. Just does usually would say up here the year, but it does not. So the balance sheet again is the snapshot in a point in time, usually at some reporting period end, quarter or year. Remember, public companies have to report minimum quarterly. And when I say report, they have to actually file their reports with the federal government, with the Securities and Exchange Commission, quarterly and then annually. Sometimes the quarterly statements, they'll say we don't have them prepared in GAAP form yet. We wanted to make our deadline, and just know they're not according to GAAP, meaning they haven't adjusted, well, whatever they haven't done yet. All the adjusting entries for accruals, deferrals, run everything current, whatever. I mean, done estimates. There are a lot of things that are done behind the scenes in order to prepare these. But quarterly or annually is usually some sort of cutoff, and that's a snapshot of the balance sheet. So you've got current assets and total assets, and then so one comparison would be, okay, what happened with all these with these values here between one year and the next? So current assets went looks like they went up. I see red here, and I think of a negative, but it's just red that sort of highlighted. Between 2026 and 2027, there's a 290,000 increase in current assets. Remember, current assets are dominated by cash, accounts receivable, and inventory. Those are the big three. They might include other things like prepaid insurance and all kinds of things that are coming your way quickly. Assets are things current assets are things which are going to be converted to cash within a year, or the operating cycle, whichever is longer, but a year is the rule of thumb. Well, it's gone up by 290,000 or 11.9%, and everything across the line, the change up or down. And if it's down, usually it'll be a negative, but everything has gone. By the way, this has gone up to treasury stock. Now, one thing about treasury stock, what is treasury stock? Treasury stock is a buyback of stock. A company will buy back its stock, and so it's actually a reduction in the owner's equity or stockholders' equity. And companies will buy back stock for all kinds of reasons. If for no other reason than to give these shares to employees as bonuses, or what is increasingly important is to find some use for cash. When I mentioned a minute ago that there's a lot of money that's sort of sloshing around the financial world, because companies have been making a lot of money. They're trying to find things to do with their money. One of the things they've been doing is buying stock back. So this is a negative. This has actually grown from one year to the next. And that would not be an unusual scenario in today's world. We've seen in the last few years a big increase in companies buying back stocks. I know President Biden has been sort of railing against that practice, thinking that it'd be better off if you have no use for cash, raise your workers' pay. It's like, well, no, we don't want to do that. No, we don't want to raise wages. Are you crazy? Not that they haven't raised wages, but President Biden obviously has a very pro-labor position. The management feels a little bit differently. They would not want to use that billions to raise wages. They would rather buy it back. So we see this sort of tension between stakeholder groups. Stakeholders, just any interested party. Workers always want higher wages, though. There was never been a worker alive, I don't think, who's ever said, "Oh, I don't want a wage increase. No, I'm good." No, I'm sure there's probably somebody out there who said that, and that's not usually the case. But stock buybacks have been very common. It's a reduction of shareholders' equity when this happens. Notice that even with the buyback, though, the total stockholders' equity went up, mostly because of the growth in assets generally, and only a modest rise in liabilities. And so, and so this is an interesting idea. This is what a purpose of horizontal analysis would be. would do, just sort of look at it. And by the way, I guess I probably should have pulled up an example of of the reporting that's done for the Securities Exchange Commission website, because it will have this analysis usually of 1, 2, or 3 years back to back to back, where you can look at it very easily, look at it and see what's going on, right? And even somebody who's not schooled in accounting necessarily could look at some of these and get a pretty idea of a big picture view of what might be happening with the company, at least from the balance sheet and income statement. I know that it's a little, you get into the statement of retained earnings and the statement of cash flows, it becomes a little bit more, a little denser, a little bit harder for people to sort of read. But certainly, I think balance sheet and income statements can do that. And then the income statement, since we're on the subject, looks something like this: the 2 years, 2026 and 2027, where, okay, sales went from 10, I think these are in thousands, 10,907,000 to 11,776. That's an 8% increase. Okay, and if you look here now, we do have one negative, and that is there's a decrease in tax expense, and it's probably because earnings did not grow as quickly, and so as a result, and well, we don't, and who knows? I'm just spitballing here. I don't know why the income tax went down, but it could be earnings subject to tax did not grow that dramatically, but it could be all kinds of things. Why did taxes go down? It could be that they bought a piece of equipment, they decided to write the whole thing off in that year, which companies are allowed to do. There are all kinds of reasons. And I also teach corporate tax, and so I can tell you that there are tons of reasons why this would be. But if you were interested, the notes would tell you why taxes have gone down. And that's something that you might want to know about. So these are uses of financial reporting statements, balance sheet, income statement, from a horizontal picture. What's going on 1 year, what's going on the next, etc. And remember, we have this form with the income statement that follows. It's a 3-step, what we call the 3-step process. Net sales minus cost of goods sold is gross profit. That's the first stage, and then you get the selling administrative, you get operating income or income from operations, and then everything which is non-operating, like interest, taxes, one-off things like losses. Maybe we lost money on something, or we had gains. We sold a plant, we got a gain, piece of land, whatever. These are non-operating items, and then you get to net income. It's the same general format, even though companies in different industries have different amounts of detail, frankly, and will include different things. And likewise on the balance sheet itself, this is actually a fairly abbreviated balance sheet because current assets is one line item. Usually current assets are broken out into those big 3: cash, accounts receivable, and inventory. Property, plant, and equipment is all lumped together. And when we say net, that's net of accumulated depreciation. It's a contra asset account. So total assets should equal total liabilities and stockholders' equity, which is why it's called balance sheet, right? This will match this, the totals on each. And but within each, and it's presented in a standardized format that we call GAAP accounting. GAAP accounting is a very important way for us to look at this. Okay. All right. Any questions about any of this before we go forward here? Okay. And then I'm not going to cover every particular slide on here, but just sort of summarizing before we get into vertical analysis, just to sort of summarize what's going on with, if we're just taking a bird's eye view, and we're starting to tear into this a little bit. We haven't looked at the notes yet, but we're noticing that net sales went up 8% between 1 year and the next. We noticed that cost of goods sold increased by 8.5%. If I were an analyst, if I were a lender or investor, I'd say, wait a minute, sales went up by 8%, that's good. Cost of goods sold went up by 8.5%, not so good, right? That's not in the right direction. You know, if you think of the value of the firm being increased with sales and being decreased with costs or expenses, costs and expenses being the same term, then the percentage change in costs, the downward vector is greater than the upward vector of the increase in sales. And so maybe that's okay. It's not a gigantic change, but it's something to think about. It's something to look at, and it's something to have question answered. If I were a banker, as I used to be, I would ask the question, why? Why did it go up? And I'm not banging on the desk and freaking out and having a coronary because it's not a huge change, but I want to know why. Why are your cost of goods sold rising faster than your sales? I'd want the answer to that question, I think. And if it were a big percentage, I would definitely want to know, and it may influence my overall decision. Remember, external users are the actors who are very interested in what's going on. Selling and administrative expenses went up by 8.2%. Is that high, low? It does. We don't know. What has it done historically? What are our peers? What are their administrative expenses are in relation to sales? I mean, I think that's important. Gross profit went up by 7.3%. Net income increased 9.9%. Gross profit is simply sales minus cost of goods sold. Net income is the bottom line, what we call the bottom line. And when we see net income, it usually is an after-tax number. Whenever you are looking at a financial statement, income statement, net income is usually after tax, but not always. You have to know whether it's after tax or not. It's not always clear. Sometimes it's only estimated. We don't really know. Frankly, corporations have to file their tax returns fairly quickly after their year end, and sometimes it's not always clear what the tax liability is. It's an estimate, and this is why companies will pay income tax throughout the year because they don't want to. Well, first of all, they have to, but a lot of it's on an estimated basis anyway. Okay, and that's just and I don't want to get too far off into the tax weeds there. Okay. By the way, when I did this a minute ago, I was flipping between balance sheet and income statement. Balance sheet, income statement, balance sheet, income statement. This is a very common tool of financial analysis, is going back and forth, comparing what's going on. And remember, one of the things that we talked about in 2110, and it was deliberately made part of the financial statement project, is that there's something called articulation. One statement relates to another statement, that they fold together. There's a logical story being told, starting with the income statement. We're in the business of operating, selling stuff, incurring costs. We make a net income. That net income, then some of it we pay to ourselves, we pay to employees. Some of it we just keep within the business, and some becomes part of retained earnings. Part of retained earnings goes into the balance sheet. And then to account for where all the money went from, we have a cash flow statement. So these statements all roll together. So retained earnings is obviously a line item on the balance sheet. So these statements interact with each other. They interact. And so it's important, this idea of flipping in and out of financial statements is a very common technique used by users of these statements. Okay? All right. So any questions about horizontal analysis? It's basically just across time is really what we're doing here. And it's funny, what's been going on. It's sometimes called trend analysis. It's a pretty important bit of what goes on. And if anybody follows business news, probably the biggest story in the business world right now is AI, artificial intelligence, and all the things that are attendant to that, virtual reality, augmented reality, machine learning, higher language learning, all these kinds of things. And so today, one of the big players, NVIDIA, announces earnings. And people are going to be comparing earnings across quarters. This company's just blowing the doors off. It's just, I have not seen a company like this in a very long time. They're just absolutely knocking it out of the ballpark. It's like Babe Ruth, came back to life and started hitting home runs. It's like crazy. It's just amazing. And so today they're going to announce earnings. Everyone's going to be comparing what's going on now versus what has happened. What is the trend? What is the percentage increase in sales? What's the percentage increase in income? Is this sustainable? What are their costs? All these things are going to be looked at. And I know that not everyone follows the business press like I do, but that is going to be a big story. And everyone's kind of watching with bated breath because it is a gigantic portion of the technology sector at the moment, which is the fastest growing part of the economy by far. Technology, no question. Absolutely no question about it. So, okay, so looking at these statements is an important exercise for users. Okay, all right. Any questions before we get into vertical analysis? I'm trying to check here periodically the chat box. You can feel free to enter something in that if you like, or just sing out. I think we can hear you. I think we can hear you. But don't feel bashful about that at all. Okay. All right. Let's talk about vertical analysis. Okay, vertical analysis is, again, it's looking at information within the same time frame, or the same area, and it's sometimes called, what we refer to as called common size analysis. Now, that may be a new term, but so let's talk about what that is. Common size is basically taking some key figure on both the balance sheet and income statement and saying everything is a percentage of that. And there are two key figures when it comes to the back. Remember, the two of the four main financial statements, the two most important by far are the balance sheet and income statement. Almost without question. Now you can debate whether the balance sheet's more important than the income statement, but there's no question that balance sheet and income statement are the two most important. So on the balance sheet, the value that's being looked at is total assets. Total assets. And so everything is expressed as a percentage of total assets in vertical analysis. So if we say current, so this example that's given here, if current assets are 22% of total assets, then we're saying that of every dollar of assets, 22 cents of that belongs in the current category. And that would include things like cash, accounts receivable, inventory, prepaid insurance, all prepaid interest, all those kinds of things, right? Is that high and low? I don't know. I think we have to, again, part of that's what management's preference is, and comparing against their peers. But everything is this percentage of total assets. Remember, assets, the definition, I think most of us know what assets are, but just to get a little bit wonky and make sure that we're all clear, an asset is a resource owned or controlled by an organization. And the formal definition goes into that it was as a result of past transactions and which has future surplus value. It's usually pretty clear what's an asset, what's not an asset. There are some times in which it's not always clear what an asset is and what is not. But assets are things which are owned or controlled and they have future surplus value. Okay. So for the balance sheet, the key value that we're keying off of, in this case, they're expressing it as a percentage of a base amount. That base is total assets. On the income statement, the other important statement is net sales. Remember, net sales is gross sales. I have an eraser here. I'll write this out for you. And I guess I don't have an eraser anywhere in this room. Okay, well, I guess I won't. I didn't think to look for an eraser. My bad. I'll deal with it. It's gross sales minus returns, allowances, and discounts, and so net sales. Net sales is the value that we start with. It's the starting point for financial analysis. Because obviously returns, we sold stuff and some of it came back. Well, those aren't sales, those are reversed. That's why we create a contra revenue. It's one thing to sell stuff, but if people are sending it back, then it's not a sale, right? You have to refund it. So net sales, that's things which we sold and which stuck and were after, and which we recognized as revenue and recorded as revenue. In this case, the example that is given is selling expenses are 16% of net sales. Is that high? Is that low? I don't know. It really depends, right? Some organizations that might be appropriate, maybe even be a little bit low. There are some organizations, by the way, selling expenses usually refer to things like advertising, marketing, promotion, things like displays, and commissions are a big one. Commissions are a huge one. There are some organizations in which some of the highest paid people are the salespeople. I come out of the financial world where some of the highest paid people are people who sell securities and do things on a commission basis. Those are huge costs, and they account for a huge percentage of net sales. Okay. All right. So that's what vertical analysis is in general. Let's look at an example. Maybe it might become a little bit more concrete once we start looking at these. And we use the term common sizing because we're shrinking everything down to the percentage of something. So in this case, we've got Chicago Cereal, our hypothetical cereal company. We have a balance sheet as of December 31st, as of 2027 and 2026. By the way, and I don't want to overly confuse the matter, but you can combine vertical analysis with horizontal analysis by saying, okay, current assets were 23.8% of assets in 2027. They were only 22.6 as of 2026. Maybe that's a good thing, particularly if you're looking to boost the liquid portion of your asset base. So that's a bit of analysis. But let's stick with the vertical. So in this case, they're all going to add up to 100%, right? All assets are going to, these are the percentage category. These are the dollar figures. These are what's reported in GAAP accounting. This is what a user would do on their own. Sometimes companies will prepare this just in very broad outlines, but this is a lot of what analysts do is sort of tear into these statements, do things with them. Property, plant, and equipment, 26.2% of assets. Other assets, 50%. Now you might think, wait a minute, other assets, can you be more specific? Well, if I had to guess, I don't know, and by the way, it's a hypothetical company anyway, it's probably something like intangible assets. If I had to guess, I'd say it's goodwill. What is goodwill? It's the premium paid for assets of a organization that's been acquired by our company here. And it's just a way to make the accounting work. You overpay. I don't want to say overpay because it's probably not, that assumes that we're making a bad decision when we acquire another company, but it's the difference between the book value of the assets we're buying and the purchase price of those. But it might be worth it to pay more because of the fact that maybe they've got it's worth it to take a competitor off the shelves against you. Now they're on your team, not theirs, not someone else's. Maybe they've got a process that's particularly good. Maybe they've got a particular product that complements your own product, and that now you're going to be knocking it out of the park because you've got two products that go together. There are a lot of reasons why that'll be the case. So I'm just guessing. I don't know what this is about. It's hypothetical, but that would be an explanation. They all sum to 100%. But keep in mind that the asset side of the balance sheet is going to be mirrored by the total on the same side on the equities side, liabilities and stockholders' equity. Liabilities being creditors' equity, stockholders' equity being owners' equity. And so you've got current liabilities, which are the liabilities coming due within the year or the operating cycle, whichever is longer. In this case, it's usually a year. And so the current liabilities are 35% of assets. Total liabilities are 77.9% of assets. And total stockholders' equity, 22.1%. A lot of financial analysts, I can tell you, will go straight to this guy right here to find out how much interest the company has, owners have in assets. So for every dollar of assets, creditors have a claim of about 78 cents on those. Okay, that may be a pretty high percentage actually, because it means owners only have a claim of 22 cents. So it's about almost a 4 to 1, about 3.5 to 1 imbalance. That's a little bit high for the most part. And I know that sometimes I'm saying these numbers don't mean much unless we start to put it in context. That would be one that I think I'd be a little bit concerned about. I'd be less concerned though when I noticed that the year before we had 80% of assets were claimed by creditors. It's gone down to 77, which means the interest of owners have gone up by the same corresponding percentage. That would give me some hope. The company has less debt as a percentage of assets. So again, everything has to be taken in, it's the big picture. What attorneys call the facts and circumstances, that's what really has to be taken into account. And if this were all super easy and everyone agreed, then there wouldn't be any doubt about what's going on in the business world, and we wouldn't have stock prices going up, down all the time. Everyone would agree this is the value of something. Instead, it's in context. It's what does it all mean? And accountants do their best to present information that is measurable, verifiable, and reliable, but it's up to the user to determine what it all means, right? And the notes to financial statements can tear into that. So that's a balance sheet view vertically, okay? And so in this slide package, it says, okay, what's being revealed here? Well, some of this I've talked about just on my own. Current assets, went from 22.6 to 23.8%. Property, plant, and equipment, and the most important thing was this area here where stockholders' equity increased. The dollar amount was $457,000. The percentage was 19.3 to 22.1%. And then I think it's probably the biggest story on that balance sheet from a vertical standpoint, but it depends on what you're looking at and why you're looking at it. All right, final bit here on the vertical piece, and then we'll take your questions, is on the income statement. So remember, the two key statements are the balance sheet and income statement. The balance sheet, the key value is total assets. On the income statements, net sales. That's sales after returns and allowances and discounts. If there are any, there may be not, right? So it's 100%, it's the amount we're keying up. Everything is as a percentage of those. So cost of goods sold in 2027 was 56 cents, meaning that for every dollar of sales, it cost us 56 cents to make that dollar of sales. That's really what that means. Okay, and so every dollar of sales yielded us 44 cents of gross profit. Is that a good gross profit? Yeah, in general. I mean, and when we get to talking more about, I know we're talking about horizontal, vertical, and ratio analysis. We're not in ratio analysis yet, but we'll talk about, in general, do you want this to be higher or lower? And obviously, we want gross profit to be higher and not lower. Is that good overall, just as a general statement? Yeah, probably so. If for every dollar of sales you pocket 44 cents, that's probably pretty good. This is what we call gross margin. Expressed in percentage terms, it's what we call gross margin. And fatter margins are better than slimmer margins. And there are organizations out there that have extremely high gross profit, including technology, by the way. There's a reason why the technology sector is growing so quickly. It's because their costs in relation to their sales are not particularly high. They don't manufacture things for the most part. I mean, I know they do. They manufacture chips and wiring and and boards and all that sort of thing. But it's not. They're not making gigantic pieces of equipment like 18-wheelers or whatnot. So their costs are relatively low and in percentage terms, and so that's why it's going. And then the service part of the economy is growing very fast as well, which also has fairly small cost of goods sales, cost of goods sold in relation to net sales. Okay, so everything is expressed in percentage of net sales. Selling and administrative. Administrative are all those costs like rent on the premises, insurance expense, employee benefits, selling expenses I just talked about. So we work our way down and we get to the bottom line of net income. And it's after tax here. We have to know whether it's before tax or after tax. So income before tax, net income. So our net income is 9.4% of net sales. Means for every dollar of sales that stuck, because we didn't have to return anything, we had 9 cents of profit after tax. And is that a good figure? It's probably a pretty good figure. There are organizations that earn more per dollar of sales, but that's not too bad. For every dollar of sales, 9 cents lands and stays. And that's after satisfying all the tax expense. This is the very, very bottom line. And whenever we have the very, very bottom line of a financial statement that's got a double line, you can't really see that here, but a double line, because we've got subtotals with one line and two lines. The two lines basically say, okay, statement's done, okay? So 9 cents on the dollar, which has gone up from 9.2 cents in 2026 to 9.4 cents per dollar from one year to the next. That's a pretty good trend. Pretty good trend. Cost of goods sold is a little higher, which means gross profit percentage is a little higher, but we're making it up, and it's probably because we've got savings somewhere here. It's in. There's probably there's going to be some. Tax has gone down for whatever reason. We don't know why tax went down, because we're actually making more money, but there could be all kinds of reasons which don't really concern us here. But this would be if we're looking at this vertically, all we're doing is we're saying everything is in comparison to that. Obviously, we want the things which add value to the company to be higher. Sales, we want to be higher as opposed to lower. Gross profit, we want higher as opposed to being lower. Anything expense, we want lower as opposed to being higher. As a general rule, although it should be noted that it's this old adage that we've all heard, it costs money to make money, you have to spend money to make money, that sort of thing. So the idea that we can sometimes drive costs down to bare bones minimum is pretty unrealistic. And I can tell you that the academic literature and business about CEOs who have tried to cut costs to the very bone, it usually doesn't end very well. Because you're sacrificing quality or cutting corners or you're displeasing employees or all of the above. And so this idea that expenses are the enemy is a little bit of an exaggerated idea, but it's held in some quarters, and so it probably bears discussing. Okay. Now, when we come back on Wednesday, we're gonna get into ratio analysis, and we're gonna see in general, because I just mentioned a minute ago, in general, you want things that add value to the company to go higher, things which take away value, like expenses and taxes, to go lower. we're going to talk about in general how these ratios stack up and how we want these to be higher as opposed to lower. So we're going to do a little bit of jumping on. So we're going to end it right here. And when we come back, I'll just wrap up a little bit of vertical analysis on Wednesday, and then we'll jump into the ratio analysis. And once we're through, once I'm through covering some of the content, then we can do some of the example problems and exercises for the back of the chapter, and then I'll give you a bit of a simulation as to what you might expect to see on the homework quiz and bonus for chapter 10. Okay. All right. So, any questions from me about anything we've talked about today? Anybody in class here or anybody on the Zoom link have any questions for me? Okay, well, and feel free to get with me anytime you like. I mentioned how to get with me on Monday. I'm pretty much available, and if you physically need to see me, I'm usually only here in the mornings on Monday and Wednesday. I do have an office hour here on Monday, but otherwise on the main campus all other times, including the rest of the day. But I'm available. Reach out to me if you have questions. I'm more than glad to help. And I will be posting the video link in the same fashion as I did last time, and I'll be doing that sometime later today once this whole thing processes. Okay. Well, everybody enjoy your 3-day weekend or 4-day weekend, whatever it is for you, and have a good day off, and I'll see you next week.